Talk of dangers ahead for the bond market are still circling in the media. Are we on the brink of a crisis for U.S. Treasuries, or are the warnings much ado about nothing? In today's video, we're going to look at the current state of the bond market and what the actual trends in demand and supply for U.S. Treasuries are showing right now. Let's get into it. If you look at the current headlines on the bond market, you might think we are on the edge of an impending disaster. Recent reports have shown that foreign central banks are dumping U.S. Treasuries, suggesting future foreign demand for U.S. debt is in question. Before that, JP Morgan Chase CEO Jamie Dimon recently said that we're going to see a crack in the bond market in the future. They are right to be concerned. The U.S. national debt is growing with no end in sight, standing now at around $37 trillion. There's definitely a lot of fear and speculation out there, but one thing I like to do on this channel is look at the data itself and not rely on media reports and other people's commentary on what they think is happening. So I rolled up my sleeves and started digging into Treasury auction results to see what the underlying supply and demand trends for U.S. Treasuries are showing right now. Today I'm just looking at the 20-year bond, and that is because there was a reported weak demand at a 20-year bond auction at the end of May, which set off a lot of concern at the time. Let's go over the Treasury auction results report that I'm looking at to give you a sense of what we're working with. These are released by the U.S. Treasury Department after every auction. There's a 20-year bond auction about once every month. There's a lot of information here, but only a few data points we need to look at today. The first is what's called the high yield. This is the yield on the lowest bid that was accepted in the auction. For bonds, prices and yields move inversely, so the lowest price bid that is accepted will be the highest yield. You can think of this as the market-setting yield for that auction. The other two data points we're looking at are the competitive bids tendered and the competitive bids accepted. I'm not concerned with the non-competitive bids because it is the competitive bids that set the market price. The non-competitive bids just state how much they want to buy and will accept the market price set from the competitive bidding. Now, why am I looking at these? The amount of competitive bids submitted at auction represents the demand for the Treasury at the auction, and the accepted bids are the supply. With these, we can calculate what is called the bid-to-cover ratio, which is the amount tendered divided by the amount accepted, and this gives us a measure of the level of demand. If you have a ratio of 2, for example, that means there were twice as many competitive bids submitted than there was supply to meet that demand. Now, let's take a look at what happened at the May 21st auction for the 20-year bond. Here's the 20-year bond bid-to-cover ratio for the last 2 years. Here's where it was for that May 21st auction. Not seeing anything weird? You're right. There isn't looking at this alone. Yes, it did dip down a bit, but this is a pretty volatile series and we had lower points at 3 different times over the last 2 years. Let's add in the high yield on the other y-axis to get a bit better sense of what happened and why people were worried at that May 21st auction. The yield came in at just above 5%, which was the highest it's been in over a year, but then it retreated a month later at the June auction. Let's look a bit more history to put this into context. Here are the two series going back to May 2020. We don't have data before that because the Treasury started reissuing 20-year bonds in May 2020 for the first time since it was retired back in 1986. Now, the bid-to-cover ratio is a volatile series, so I'm going to clean it up a bit with a trailing 2-month moving average. Now we're starting to see a bit of a problem here. Once we smooth out that volatile bid-to-cover ratio and look at the underlying trend, we can see that it has been trending lower over the last 2 years as interest rates have been rising. The gradual downtrend in the bid-to-cover ratio indicates that we're seeing lower demand for 20-year Treasury bonds, even though the yield has been rising. If those two trends continue, then yeah, we have a big problem on our hands. Now, I'm just starting to dig into these Treasury auction reports, and I have a lot of questions about what I'm seeing here. Is there something similar happening for short-term Treasuries, for example, or is it just at the long end of the market? I don't have a deeper history for the 20-year bond because it was reissued just in May 2020. Could it be that the bid to cover ratio is just returning to a long run average that is lower than where the ratio was 2 years ago? These are important questions that will give us some insights into whether what we are seeing in the trends for the 20-year bond are a big warning sign or not. Honestly, I haven't seen anyone else looking at the bond market from this angle before, so I'm going to keep going through these Treasury auction reports to put together the data and analysis for future videos. If you want to stay up to date on some of the best bond market analysis you can find on YouTube, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss my next video on the topic. And if you think it is awesome that I'm sifting through years and years of Treasury auction reports, don't forget to hit that like button on your way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.